That's it, game over. Gone are the days of easy money. Gone are the days when you could YOLO all of your money into Dogecoin and become a millionaire. Gone are the days when, if you missed Dogecoin, you could YOLO all your money into Shiba Inu and become a billionaire. Here come the days where CNN recommends that you lose your password to your 401k accounts. This was such a crazy week. There was a lot of clarity that happened this week with regards to the Fed telling us what's about to happen to the future of stocks and crypto and everything else. So if you didn't watch the hours and hours of press conferences from the Fed meeting, and if you didn't read the principles for reducing the Federal Reserve balance sheet because you're not a money nerd like me, then I'm gonna give you a brief summary of what happened and what's about to happen next. I'm excited, let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the drama. So much drama this week, from stocks to crypto, the volatility, the Fed, meet Kevin selling all of his stock portfolio and getting called out for it, me using his Titanic reference and getting called out for it, Graham buying NFTs and getting called out for it, Jeremy finally buying Bitcoin and getting called out for it. It was crazy. I'm just kidding. Those two didn't actually buy any of those things. They're still boomers. I want to quickly address something that I did in my last video where I used a Titanic reference because I thought it was brilliant, so I ran with it. I saw it on Instagram, I saw it on Reddit, and I had no idea who to give the credit to, so I didn't, hoping that people would correct me. And by the time I gave the credit, it was too late. People were like, "Oh, you stole it from Kevin." So it was a sincere mix-up. I apologize to Kevin, and to make it up to him, if you don't know who Meet Kevin is, he's an incredibly talented finance content creator here on YouTube. He is way more talented than me, way more successful, he's got way more money, and he's way smarter than me. And I'm not just saying that, I really do believe it, and I've learned a lot from him over the years, and I know you will too. But all of this sort of got me thinking, because here on YouTube, the finance content creators or YouTubers are like the least cool YouTubers because we don't drive fancy cars, we don't have flashy lifestyles, we're all friends here. But it doesn't stop people from creating mountains out of molehills because drama's fun and it makes the world go round. But it also got me thinking in the context of Kevin selling all of his stocks because he got a lot of flack for it. When I first heard about it, I didn't think much of it, and I can't speak for Kevin, but here's what I've learned. Before I started my YouTube channel, my goal was to take $1 million, invest it into a dividend stock portfolio that's yielding on average 4% per year, which would give me $40,000 a year of passive income for the rest of my life that I would retire and travel the world on. But thanks to YouTube, I was able to reach that point relatively fast. But I never went through with my strategy. And I know for a fact that if I could time travel to the 3-year ago Andrei before YouTube, and if I was to tell that Andrei, hey, today I'm buying NFTs and speculating several $100,000 on these assets like Pokemon cards and I live in an expensive house, the Andrei of me 3 years ago would have just called myself an idiot. You've changed, man. Money's changed you. And I'm not talking about lifestyle inflation or anything like that. It's because what got me here won't get me there. And what got me here is living extremely frugally, living way below my means, eating ramen noodles, but normally human beings want to reach for more. And what I didn't take into account 3 years ago that I do today is that I still work hard, if not harder than I did 3 years ago, because I want to realize my potential. How far can I take this? How long will I have this privilege of having a YouTube audience? Maybe long enough that I can create something bigger than the YouTube channel itself. I don't know. But the point is if you want to get to that next level in life, which I believe normally human beings want to do anyway, we have to change our relationship with money at different stages in life. Personally, I take more risks, for example. I understand hedging and leveraging and creative ways to offset my higher income. And I'm even considering doing a cash out refi and pulling out 80% equity out of my fully paid off house just so I can take that cash and invest it into a more liquid investment like a stablecoin like USDC, which could pay up to 8% per year in interest, which would be enough to pay down my new mortgage loan and give me some options if a new, better opportunity presented itself. The point is, 3 years ago, Andrei had no idea this was possible because I didn't have that vantage point. That wasn't my circumstance. So to tie it all back to Kevin, I think it's easy to look at someone's $30 million net worth and make an assumption about what he's doing and think to ourselves, well, I would never sell my stock portfolio. I would be in capital preservation mode and I would invest it in bonds or into a 4% dividend yielding portfolio, and I could make $1.2 million a year and live off that for the rest of my life. But at the end of the day, We're not Kevin, and we don't have his vantage point and his circumstance, because perhaps for him, it makes sense to sell out and do what he's doing, because even if his stock portfolio went to zero, which I don't think it ever will because he's just too smart to let that happen, he would be perfectly fine. If anything, I'd say it's a question of responsibility in terms of how Kevin chooses to use his power of influence in helping people along their investing journey. But what makes sense for Kevin to do may not make sense for everyone else to as well. But he has to be honest with himself and balance that out with the transparency of his actions. And so far, I think he's done a really good job. It's just that ultimately, those decisions are not up to us to make. Personally, I try to understand other people's perspectives and vantage points before I make an opinion. And sometimes I don't fully understand, which is why I don't have an opinion. But all of this to say that Kevin's Titanic reference was awesome and to leave Kevin alone. But now let's talk about the thing that is on everybody's mind right now, the crypto winter. But first, what is a crypto winter? Technically, a crypto winter is defined as a drop in values for an extended period of time. And since we've lost over $1 trillion worth off the market cap of crypto, and we're down over 50% from the all-time highs, I'd say we're kind of already there. Plus, there's talks of a new executive order directly from the president issued as early as next month, February, which is supposed to give us more clarity on taxation and regulation, and we don't really know what's inside of this new potential executive order, but that doesn't stop the market from speculating and creating rumors about the new stablecoin and everything else, which gets investors scared and they sell, the market drops. But the real question is, how long will this crypto winter last? And the answer to that question depends on this guy. This guy's job is to make a really difficult decision. Like if this 10 of hearts was the economy, his job is to pick between inflation and employment, which is impossible unless you're a magician. His goal is to walk that thin line between cooling off inflation, not crashing the markets, while keeping everyone employed. And that's probably the single hardest job on earth right now. And because the answer is not spelled out for us, because we have no idea what he's gonna pick, it's our job to guess which one he does month to month, and that's the name of the game. But this week has been pretty crazy because the market went up, it went down, it went up, and it went down, and there's a few reasons why. And the biggest reason is because investors were looking forward to tech stock earnings. And tech stocks are an extremely important barometer in helping us see what's going to happen to the economy in the near future. The second reason the market went down is because of geopolitical conflict, but that's a whole separate enchilada. So earnings did come out this week, and the earnings were really strong. Microsoft, for example, beat analyst expectations. They reported $18.8 billion worth of profit, which is an increase of 20% over the same time period last year, but the stock still went down 5% on Wednesday. How does that make any sense? Also, Tesla had a record year of profit. Their expected earnings per share, EPS, was to be $2.38, but they reported $2.54, beating expectations by 6.8%. Their revenue was expected to be $16.6 billion, and they reported $17.7 billion. That is an increase of 6.5% over the expectations. But the stock still went down over 5% on Wednesday. Again, how does this make any sense? To be fair, Tesla did end 2% on Wednesday in the green, but still, why are these companies making all of these earnings, and how are their stock values still going down? Is this the sign of a coming winter or a recession? I think I found the answer with this article right here. Tesla records a record profit, but its outperformance was below average. Think about that headline for a second. Its outperformance was below average. So you're telling me this company did better than you expected, just not way better, therefore you're gonna sell it. That is why, if the only information you had on hand right now about a company is its earnings, and if you had a time machine to travel back before they announced their earnings, most people would buy into the stock hoping to make some money, right? Because you know it's gonna beat expectations. But the reality is, if you had done that, you would have lost money. How does that make any sense? This is why it is almost impossible to try to predict the market, because sometimes it's irrational. And part of the reason why this happens is because in addition to earnings, companies also give us their guidance, their future projections as far as what they expect will happen in the near future. And a lot of the tech market right now is telling us tech was king, but these kinds of growth numbers are just not sustainable. Spoil you once, shame on me. Spoil you twice, you can't get spoiled again. And so when investors hear that, they're like, man, when I want to be spoiled, I'm gonna sit out of the market until you could spoil me again. But then it does get a little bit more complicated with the central bank and the Federal Reserve and the things that Papa Powell looks at to see if the economy has recovered are finally starting to look good. High wage growth, high employment, high company earnings, and everyone was making all of this easy money in the market kind of reinforces this thought process that the economy is strong, time to cool it down. And that's when everyone screams, "Gayaka, Gayaka!" So finally, Jerome Powell came out on Wednesday to tell us exactly what he's thinking, and here's what he said. He wants to increase the federal fund rate as early as March. And remember, the federal fund rate is the cost for banks to borrow money from each other. Right now, that cost is 0, but the market has priced in 4 increases. Each increase is 0.25%. That means the market has priced in a federal fund rate as high as 1% by the end of the year. In a nutshell, members of the FOMC are all in agreement with each other that raising the rates will not affect the labor market. But he did say something in there, though, that really did scare the markets, which is that the Fed will be moving away from very high accommodative policy to substantially less accommodative policy, and over time to a policy that's not accommodative. It means that the time for making easy money in the markets is coming to an end. So their strategy moving forward is that next month, in February, they're still gonna print $30 billion worth. And by March, they're going to stop, at which point they're gonna reverse course and start to sell off their $9 trillion balance sheet. Remember, 5.7 trillion is treasury bonds and the other 2.7 trillion is mortgage-backed securities. The real question though is, when are they gonna start selling? How much are they gonna start selling? And how will all of this affect the markets? I try to find the answers in their principles for reducing the Federal Reserve balance sheet, but it did not give any specifics. It was completely useless. Why can't they just teach this stuff in school, or why can't they just tell us exactly what they're gonna do? It's so frustrating to try to guess. It just says that they're gonna play it by ear and adjust it up and down depending on the market conditions, which I guess makes sense. So I tried to find other guesses, and the best guess I was able to find was from Goldman Sachs, which guesses that they're gonna start reducing in June. That's when they're gonna start selling at the rate of $100 billion a month. Ultimately, for me, the biggest question I have is this. If the Federal Reserve balance sheet was $4.1 trillion before the pandemic started, and if it's at $8.8 trillion today, if we assume a rate of $100 billion a month in a decrease, wouldn't that take 47 months to fully taper? That's almost 4 years. So either Goldman Sachs is wrong, or they're actually gonna take 4 years to taper. Either way, I have no idea what's gonna happen at that point because I can't see that far into the future. But either way, I'm just paying attention to jobs for the middle class. I'm calling my parents every week and asking them about their job, about their wages, because if those wages and those jobs get cut, that is probably the single biggest indicator of a coming recession, which I honestly don't think we're gonna have this year based on everything we know so far. Until we get more clarity from the Federal Reserve as far as what they're gonna do with the sell-offs and at what pace, then there's gonna be more pain to come in the market because there's more uncertainty. And that brings me to the ultimate point of what I learned this week. It might seem super obvious right now to just sell everything, right? Because if we know for sure that in the next few months, things are only gonna look worse, why not just park our money in cash, sell everything, and just wait on the sidelines? And the reason you don't want to do that is because even if you got the timing right on the exit, you'll almost certainly not get it right on the re-entry. And this is because even if I knew 90% for sure what was gonna happen to the economy, I would still never sell because there's a huge difference between knowing something and living through it. And when you're selling out and you're sitting with all of this cash on the sidelines and you're watching other people make money, you get extreme FOMO. And that's exactly when you're gonna make the mistake of buying back in at a higher price than what you sold at, and you lose money. That is why I'm staying invested. I'm not selling anything. I'm here for the long term. And it's also why, in the meantime, I will see you back here on Monday and Friday, sometimes a Wednesday, for our weekly group therapy sessions so I can make sense of what's going on. And in the meantime, go grab up to $250 worth of free Bitcoin with this BlockFi link right here. Go grab your free stocks, links down below. Go track them with the spreadsheet, link down below in my Patreon. Love you. Thank you so much for watching this video. I'll see you back here on Monday and Friday, sometimes a Wednesday. I'll see you soon. Bye-bye.